Hello, this is Joe Pryor, the virtual real estate team, and it's that time of the month where I become or try to become Nostradamus and predict the future. And the future is what on everybody's mind, if you're a person buying your own home to live in or an investor, is what the heck is going on with interest rates. Now, we've seen recent announcements about inflation, and inflation is the enemy of interest rates. It's also the enemy of pricing because things tend to go up, not just interest rates, but prices of everything. And we've seen some incredible increases on things like oil, for instance. Oil has gone anywhere from about $45 a barrel not that long ago for West Texas Intermediate crude, which of course we produce a lot of in Oklahoma and in Texas. It's now around $70 to $73 a barrel. That's a real problem because oil is in a lot of products, including roofing. We turn it into gas, so your private contractor, if he has to pay more for gas, then it costs you more money. Now, the other things are building materials, sheetrock, OSB board, lumber, especially at a 334% increase. Now, the Federal Reserve has said that these are transitory. They say these are temporary. The question is whether the market believes it or not. So we've gone from about a 2% inflation rate upwards to maybe as much as a 4 or 5%. Now that's the way the federal government measures it. It may not be real world, it may be actually more than that. But we're starting to get signs that it is transitory in a lot of areas. Oil is now starting to drop down again as production ramps up, it always does. We just saw a 46% decrease in lumber. We're seeing about a 23% decrease in OSB board, and so new construction costs are coming down. Energy is coming down. That's not the only thing that's happening. And so what we're seeing is a stabilization in interest rates, mortgage-backed securities, treasuries, everything is now kind of back to the area where it used to be. And that's a very positive sign. And at this point, the Federal Reserve has indicated that they're going to keep up with the $80 billion a month of quantitative easing where they buy mortgage-backed securities, treasuries. They pulled back on junk bonds for the stock market, but still, from the point of view of mortgage-backed securities, it's still there. Now, a couple of the Fed governors recently announced that it may not be low interest rates all the way into 2023 and beyond, that there's a possibility for increases next year. They're going to look at it. But the good news right now is 2022 is still looking solid. I tell you what, these rates are unbelievable. And inflation is inevitable. As economies heat up, as trillions of dollars is being printed to rescue us from what the pandemic did to the economy, inflation's down the road. So the idea right now of locking in a 2.5%, 3.5%, 4.5% interest rate is a fantastic idea because it will go up. Not necessarily soon, but it's inevitable. I've been through, at my age, way too many market cycles. I know it's coming.